Welcome to It's the Economy, and this is an important chat. The November CPI inflation has come in exactly as per market expectation, the CNBC-TV18 poll at 5.5%. And importantly, down from the October level of 6.21%. Is this low enough for the new Reserve Bank governor to cut rates in February? And more importantly, is growth as bad as the IIP is making it out to be? Many Indian companies privately complain of no uptick at all in the third quarter, or very little uptick. So what are the growth inflation pressures confronting the Reserve Bank, and how should they move? I have with me two excellent economists, Abhishek Upadhyay, senior economist at ICICI Securities PD, and Upasna Bhardwaj, chief economist at Kotak Mahindra. Thank you very much, Upasna and Abhishek, for joining in. Upasna, what is the sense you are getting in terms of the February move? Do you think that if December came in higher than November, say at 5.6, the governor would be in a slightly difficult position?
Yeah, Latha, actually, if we look at the high frequency data for December, the last 10 days, 11 days of food prices, it's not really giving us a very great picture. We are looking at a possibility of, unless we see a next 14, 15 days of a major downtrend in vegetable prices, at the moment, we are still continuing to see price pressures continue, which means more or less the headline reading looks closer to the existing reading, which is around the handle of 5.5%. And that will pose a little bit of a challenge for the governor. Eventually, they have emphasized, at least in the past, that they are looking for the last mile of disinflation. So they will have to be watchful on that front. And at the same time, of course, we have talked about this before as well, but global environment will be crucial. There may be stability, there may be instability, so we'll have to wait and watch for that as well before the February policy. Thirdly, the growth aspect, as you mentioned, RBI has definitely, as per our estimates, even talked about the second half of the year on the higher side, which is at 7%, while we are actually materially lower at 6.2%. Data going ahead will have to validate that, and we will have to be watchful on all of these fronts to see how things pan out. But I think it's a close call for February now. I would not say it's a given. It's there on the table, but, the subsequent readings are going to be important to determine whether February is a given call or not for a rate cut.
Right. Well, actually, Upasna, you put all the points on the table, but I'm going to take them one by one to Abhishek. Abhishek, this last December, your estimate of December, if you look at the Reserve Bank's October, November, December forecast, it is 5.7. So at the moment, even if it is 5.6 in December, their 5.7 is achieved. But imagine going into a policy when November was 5.5 and December was 5.6, and you are saying that I am very confident of 4% 6 months down the line. Is that credible enough? Do you think they can do that?
Well, I agree. It's not a done deal. Although the baseline view that we continue to stick to is still for rate cuts to start in February. I think RBI will have a lot more information. They will have the January high-frequency price data as well when they will be meeting in February, and that could be crucial. Latha, you have to recognize that inflation profile is changing quite rapidly between quarters. So October, December is 5.7%, Jan, March is 4.7%, and then as you head into the next fiscal year, inflation is slowing down towards 4%. So inflation profile is moving rapidly. And as long as inflation internals don't worsen, and we don't see a real worsening of or a real broadening out of price pressures, given the global backdrop we have currently with commodity prices, etc., being quite low, and domestic data on growth, which we expect to improve, but there could still be some downside risk to RBI forecast. Given this backdrop and with the framework that monetary policy has to be forward-looking, we think, RBI should be able to start its policy recalibration process. We think they have moved in a quite an orderly way by changing stance first, then announcing a CRR. I think a natural course will be for them to ease in February.
Okay. Yeah, no, everything looks like that. But I was just pointing out it's a little awkward if the December inflation comes in higher, and especially because, like Upasna says, many people were worrying that vegetable prices haven't still quite fallen as much. But let me come to the growth argument. You know, by the time you come to Feb 6th or 7th or whenever the policy is, you will get the revisions also. And the CEA has gone on record to say that 5.4 is likely to get revised. Do you think there is a good chance that when he comes in the first week of February, the growth picture is not as bad as this 5.4 made us believe? Abhishek, I think you all have a stronger view of the second half growth.
But Latha, they will not have the third quarter GDP data or
No,
the full year estimates when they meet in February. In fact,
they will have full year estimates. They will have full year estimates, no, from the NSO?
They will have the first advance estimates, but which is data effectively for first 8 months only, which could well be lower. I mean, you are extrapolating growth from first half, which has been weak for the full year. So that number could well be on the softer side. But yeah, I mean, our base case is growth in the second half of the year should be 7%. And as we move into the next fiscal year, it should slow down somewhere between 6.5-7%, which is our estimate of trend growth. So, I mean, absent a global recession or a supply side shock-led surge in global commodity prices, we think that is where growth should settle down. And second half growth, as we know, I mean, agriculture growth itself can be double potentially of what, I mean, the growth rate in the first half, and government spending will be strong. So all this suggests, I mean, growth should be better. How much better we have to see, and we'll not have clarity about that till the end of fiscal year.
Okay. Well, Upasna, what's your sense of how much growth can pick up? Do you think that the fisc will be really able to spend all that they have not spent in the previous months? And liquidity has loosened, I mean, from the Reserve Bank's point of view. But if you see the daily interbank liquidity, it is still tight. Deposits, even by state-owned banks, are being raised at 8%, etc. So do you think growth can really get charged in the third quarter and in January because of fiscal spending and somewhat monetary looseness?
So, Latha, we too expect that the government spending obviously has to pick up, But having said that, I think there's a limit to which the capex can pick up within a short span of time. So we are looking at a fiscal deficit of about 4.6% of GDP, about 30 basis lower from what they have budgeted. And much of that is obviously coming because of their inability to probably spend entirely what they have budgeted under capex. So we believe that the government will not be able to spend completely, and that will have a bearing clearly. So that is one of the reasons why we believe that the second half will not be as strong. We also believe that from 5.4%, clearly H2 has to be better. So, that part is clear. The scale at which the improvement will be seen is a function of how much government spending will be there. I agree with Abhishek. Agriculture is one place where one sector wherein we will see big contribution coming from. But apart from that, the private segment is fairly weak still. Until we don't get clarity further on that data, we remain a little skeptical on that front. So I think on the private sector, non-farm private sector, we believe that demand is a little patchy, and that will keep overall growth at sub 6.5% for the second half of the year. So yeah, we are a little on the downside there.
Abhishek, will really rate cut get passed on much? I mean, I'll come back to Upasna also on that question. Considering the liquidity tightness, considering that banks are paying a lot of money to get deposits, even the fiscal transfers for the centrally sponsored schemes now are out of public sector banks. They're being transferred through a portal of the Reserve Bank called the SNA Sparsh. So state-owned banks are also genuinely losing the idle or reliable idle float that they used to get from more quarters. Will a rate cut be passed on, or do you think that Reserve Bank is better advised to stick with liquidity instruments like, purchase of government bonds?
Well, Latha, yeah, I agree that liquidity conditions continue to be a key risk factor. There's been a lot of talk about how liquidity conditions were tight in the first half and how that weighed down on growth. We think the underlying liquidity situation is much worse now compared to what it was in the first half of the year. because of all the FX outflows and the sharp intervention we have seen from RBI starting October. While CRR cut has been announced, we do think more action will be required from RBI to make sure that the banking system liquidity situation doesn't tighten abruptly, and that is one factor where we expect more intervention. That said, if RBI were to announce a rate cut in February, and we believe another one is likely thereafter, there is scope for G-Sec yields to go down, which should effectively, assuming better liquidity conditions as you head into the new fiscal year, which should ultimately mean lower cost of funds as well. So that is already we know credit deposit wedge which was there earlier, that has normalized also. So
you think also, cost of capital for corporates will fall if they give a rate cut?
Yes, modestly. It is not going to be a game changer. I don't think monetary policy loosening is going to be a big driver of growth rebound in next fiscal year. All we are talking about is policy recalibration, how RBI can set the lowest possible repo rate given global conditions, which is not very, very low. 6%, is only modest easing. So not a game changer, but some fall likely.
Okay. Upasna, what's the in-house view and maybe even the market view on where the currency is headed? Today, we're really surprised, the dollar index went to 107 plus, and I think it is still there. And all Asian currencies are actually weaker by not much, about 0.1 to 0.3%. But the rupee is actually a tad stronger, 0.02%. So it's full-on intervention in the forwards, in the NDF market, in the NDF forwards. It's like big intervention. What do you think? You think that the FX, what are your FX levels anyway, by the time we come to February?
See, Latha, again, we'll have to look at a couple of factors here. One is, of course, that, much of the drivers right now are global and they are all in favor of the dollar, till we don't get clarity on, Trump's administration, the policies, the economic and the trade policy. I think there is going to be a lot of volatility around it. And hence, pro-USD and hence, rupee will also remain under pressure. Capital outflows, we'll have to be watchful. But I also believe that a lot of pro-US information has been priced in as well. So once we tide over January, I believe that from February onwards, we are looking at some kind of a respite coming in, which is not to say that it brings in any appreciation bias to the currency. It's just that, that constant pressure which is there might ease out a little. And hence, while of course we are looking at, the move gradually, dollar rupee moving towards 85 to 86 range through the course of CY25. But it is going to be a gradual move. And as you said, RBI will be there to manage this. We're still not in such dire straits that RBI's conscious FX management policy will be the key. And that will determine the pace at which rupee is going to weaken. So the weakening bias remains intact. But I think the next quarter, we will be in the range of 84.75 to 85.25.
Point taken. Actually, there are a lot of people over there who talk about the yuan at 7.3, 7.5 and 8 with such ease that all that will mean a much larger depreciation. Very quickly, Abhishek, you are among the strongest growth forecasts. You have the highest growth forecast for the second half, along with the Reserve Bank. You're almost in step with them. But when you anecdotally speak to FMCG companies or banks, they are not at all sure that Q3 has picked up. Last word on growth and a brief one.
High frequency data has improved. So whether you look at the retail sales for two-wheelers or autos, or even other indicators, fuel sales, etc. There is a definite improvement. At the same time, I'm not saying there are not soft patches. GST collections, for instance, year-on-year growth has slipped deeper into single digits, 8.5% growth last print compared to 9.5% FITD growth, which is just about nominal growth. So there is, scope for improvement, but there is sufficient boost I mean, from fundamental triggers which we
Okay.
discussed, I mean, agriculture, government spending, and the high-frequency data which gives us confidence.
Okay. Thank you very much, Abhishek and Upasna. You all are leaning towards the likelihood, enough reasons for a February rate cut. But at the moment, the market itself seems to have some doubts over the growth forecasts. Red all over everywhere. Every index is down over 1%. That's it on Bazaar. After a break, Chartbusters.